All right, so this is our second meeting, and we're going to go over some homework today, and then we're going to go to a new topic, still in chapter 9, right? So last week we talked about the outline, the syllabus, getting the textbook, which most of you should have, right? And all of that's explained in the first video. So if you missed any of that, you should go back and watch that. What do we have coming up? So we have the chapter 9 homework, which is due tomorrow, September 11th. It's due just before midnight. And then we have 2 weeks till we have the next assignment due, chapter 10. Chapter 10, stockholders equity. If you look at the videos, there are 3 videos for that chapter. So that's a little kind of a detailed chapter, right? So after tomorrow, you have a little bit of a breather. But again, try to stay on top of this. Don't let this get out of control, because then it just creates problems. So let's take a look. Okay, now this is the video that we started to watch last week. And then the second part of it is on the homework. So let me pause this. Okay, so I'm back with you now. Pretty boring stuff, right? I mean, I don't know how else to describe it, but I mean, those are the entries that you have to learn how to do. Now, let me take a look at something. Oh, wrong thing. Yeah, here's the video where we're going to see how to do the, no, wrong chapter, sorry.
You have all these on Blackboard for us, right?
Yeah. This was the solution to the problem that I just did. Right, and there's a little mistake here. I don't know if you realize it. See this credit of 784, it should be a debit. Right, that should be a debit. Let's see this one. Yeah, maybe we'll go over this. This is the, because I'm not sure if the video is up with that. Let me see. This is problem 9-6A. 9-6A. So let's see if we can go over this together. Nine dash 6A. Which is on page, this is also on page 481. All right, problem 9-6A. And this, this is like the problem is in the textbook where you have a table. Now, I guess we're only doing the table for a few periods, right? We're not doing it for the full 10 years or whatever it comes out to be. All right, so let's take a look at this. This is 9-6A. On January 1st, 2021, Universe of Fun, that's the name of the company, issues $900,000 8% bonds that mature in 10 years. The market rate of interest for bonds of similar risk and maturity is 9%. So if we're paying 8 when everybody else is paying 9, we'll get less than face amount. Right? And they issue for $841,464. Interest is paid semi-annually on June 30th and December 31st. So they want you to complete the first 3 rows of the table and then make the journal entries to issue the bonds and the first 2 payments of interest. So once you have the table constructed, that becomes a very simple thing to do because all the numbers that you need are already there. So look how the table is constructed. You have a column for date, and the first date is the date that the bonds are sold. Those bonds were sold on January 1st, 2021, and then you're going to list all the interest payment dates. So June 30th, 2021 is the first interest payment. December 31st, 2021 is the second interest payment, and that's all they asked you to do. In reality, if you were doing this for the full 10 years, you would have 10 years times 2 interest payments is 20 interest payments plus this January 1st entry. So your table would be 21 lines long, right? So they didn't want you to do that. That becomes too tedious. So they just wanted you to do enough to get the hang of it. The second column is the cash paid. The cash paid is based on the face amount and the stated rate of interest. So in this problem, the face amount was $900,000. The stated rate of interest was 8%. If you multiply, that gives you $72,000, but we only want half that because we're talking about half a year. That comes out to $36,000. And every cash paid amount is going to be $36,000. You're going to do this, right? If you were doing the entire 10 years, that's $36,000 times 20 payments. So every time you make a payment, every time you have to write checks, it's going to be for $36,000. Right? This is the crazy number here because this number is based on carrying value times the market rate. So interest expense is the carrying value times the market rate. The carrying value to begin is $841,464. The market rate is 9%. That gives you that $75,732 times 1/2 is $37,866. So that's where that $37,866 comes from. And now you have this column here, which is increase in carrying value. That's the difference between the 2 columns. So $37,866 minus $36,000 is $1,866. Now the carrying value, when bonds are sold at a discount, the carrying value increases over time. So I want to take this 1866 and add it to this 841, and I get a new carrying value, 843,330. I need that number to calculate the next interest payment. So to make that second payment, 843,330 times 9%, 75,900 times 1/2 is 37,950. That's where that 37,950 comes from. And again, the difference between the 2 columns is 1950. That 1950 gets added to this 843 to come out to 845,280, and you would just continue, right, to the next payment, the next payment, the next payment, and so on. What this doesn't show you that I wish it did, that maybe they should have done 3 years instead of 10, and this way you could have done the whole chart. But eventually what's going to happen when you get down to the end, now these were what, 20-year bonds? So 20 years would be, or 10 years, right? 10 years would be 2031. When you get to December 31st, 2021, what numbers are going to be here? Well, this number here is going to be 900,000. this number is going to be 900,000. The 36,000 will be there. I really can't tell what these two numbers would be, right? But eventually you've got to wind up, carrying value winds up eventually being the face amount. And what happens with discount? Over time, the carrying value increases. Since the carrying value increases over time, what happens to interest expense? That also increases a little bit. See how here the difference between these two is just under $100, right? So over time, interest expense increases because the carrying value increases. Now, they want us to make entries on January 1st, June 30th, and December 31st, that first year the bonds were sold. So debit cash for the amount you received, $841,464. Credit bonds payable, always for face amount. Remember, whether the bonds are sold at premium, discount, or face amount, your credit to bonds payable is always for face amount. The difference between the two, $58,536, is discount. And remember what discount really is. Discount is additional interest expense. Additional interest expense. So we're going to spread this $58,536 out over the 10 years, not in a straight line. I wish it was that simple, but we're going to spread it out this way, right? You can see. And at the end of the 10 years, if you were to add up this column, this increase in carrying value column, if you were to add up all the numbers in this column, it would come out to that $58,536. So what is discount really? It's additional interest expense. Now, the first interest payment on June 30th, the numbers come right off the table. So debit interest expense, $37,866, we calculated that. Credit cash, $36,000, we calculated that. Credit discount on bonds payable, $1,866, we calculated that. Same thing for that second payment. Debit interest expense, $37,950. Here's where we calculated that. Credit cash, $36,000, right? This is where we calculated that. And credit also discount on bonds payable, $1,950. This is how we calculated that. All right, so that's problem 9-6A. 9-6A. Now, 9-7A isn't up there for some reason. All right, so maybe we can do that. We'll do that together live. No, that's not what I wanted. I'm sorry. All right, so let's use Excel to do it. All right, and since we're going to be doing journal entries, so this is problem 9-7A, right? And this is on page, this is also on page 481. So since we're doing journal entries, we want a column for the date. We want another for account titles, debit, and credit. Okay. How we doing so far? Everybody okay? You awake? Am I putting you to sleep yet?
No.
This is boring stuff, guys. I mean, I got to tell you, it's boring stuff, but it's good stuff and it's stuff that's useful. And even though, I mean, I got to honestly say this, you may never see bonds in your life as an accountant. You go to work for a company, you work for an accounting firm that deals with, medium-sized businesses or even large businesses. Bonds are not really used that often anymore. I don't know why. I guess because they're too expensive to underwrite. Um, but the thought process is good because you're going to see these calculations of how you calculate interest and things like that. That's very good to know. That's very good to understand. So number 7, Coney Island Entertainment issues $1,300,000 of 7% bonds due in 15 years with interest payable semi-annually on June 30th and December 31st. Calculate the issued price. Oh, God, now I know why I didn't go over this. Hold on. Yeah, the problem is I wanted to cover the topic where you calculate how much cash you receive when the bonds are sold. Right? It's a very interesting topic. But the way this book covers it, you need to have a special calculator. And I don't know if everybody has the calculator. So I had to abandon that. That's the way they want you to do it. And that's not really, if you don't have the calculator, it's very difficult to do. So let's see if I can find another one with a premium. Bear with me a second. Yes, I remember that problem I had last semester with that. It was somewhat disappointing. Okay. I'm going to abandon that, right? Because I can't find a problem with premium. And I want to get to the next topic. So sorry about that. That just wasted a few minutes. Sorry. Okay. So the next topic we have is retirement of bonds. What happens when you pay off the bonds early? Now, again, if you were to pay off the bonds at maturity, what would you do? It's very simple. Debit bonds payable, credit cash for the face amount. But what happens if you sold 10-year bonds and maybe 3 or 4 years into it, you decide that you want to pay them off? Maybe, you have the extra money now, you can pay it off immediately. And that's a good thing to do because you don't want to pay extra interest, right? Let's take a look at the solution to the problem. Okay. This is exercise 916. Exercise 916, which is on page 478. And you see the table there again, right? See it? So the table is something that, and it's something that it's worth knowing how to construct because it has various applications. So if we take a look at that, on January 1st, 2021, Splash City issues $500,000 of 9% bonds due in 20 years, right? That's all the face amount information. With interest payable semi-annually on June 30th and December 31st each year, the market interest rate on the issue date is 10%. So the bonds are issued at a discount. Bonds are issued at $457,102. Using an amortization schedule, show that the bonds have a carrying value of $458,633 on December 31st, 2022. So you see what I did? I did the table up to December 31st, 2022. All right, so if we go back to the table again, what do the columns represent? The date represents the date the bonds were issued, which was January 1st, 2021, and then each interest payment date up to December 31st, 2022, right? So that's 1, 2, 3, 4 payments. What's the cash paid? What's one payment? 900,000 times 500,000. Hold on. 500,000. I don't know where this 900 came from. That's another typo. 500,000 times 9% times 1/2 is 22,500, right? 500,000 times 9% times 1/2, 22,500. So that's where that 22,500 comes from. Every 6 months, you were going to write a check or a series of checks that add up to $22,500 to pay interest. But paying interest is not the same as interest expense. It's not the same because we have this discount. And notice, if you look at this interest expense column, the interest expense is more than the cash paid. You see it? It's more than the cash paid. Why? Because we have that discount, which represents additional interest expense. So how do we calculate the interest expense? It's the carrying value times the market rate times 1/2 comes out to be 22,855. 22,855. The difference between the interest expense and the cash paid, 355. Add it to the carrying value, get a new carrying value. So now we're going to take this new carrying value, 457, multiply it by 10% times 1/2, and we'll come out to this 22,873. The difference between the two columns, again, 373. Add the difference to the carrying value, get a new carrying value, right? And then do the same thing. Multiply the new carrying value times 10% times 1/2, and you'll get a new interest expense, and so on. And notice that the interest expense is a little bit higher each time. Notice that the carrying value is gradually creeping up. And at the end of the 10 years, 20 years this time, right? At the end of the 20 years, the carrying value will be the face amount, 500,000. Now look what they want us to do. They want us, number 2, if the market rate of interest drops to 7% on December 31st, 2022, it will cost $601,452 to retire the bonds. Record the retirement of the bonds on December 31st, 2022. So in plain English, what's happening? I'm going to pay off those bonds for $601,452. So notice I've got a credit to cash of $601,452. I didn't have to calculate that number. They gave it to me. I also have a debit to bonds payable for $500,000. Debit bonds payable $500,000. If I pay off the bonds, right, the bonds payable account should be 0 when I'm finished. Debit bonds payable for $500,000, credit cash for $601,452. Now it would be great if that was it, and I just took the difference between the two and just shoved them into some account, right? But I really can't do that. So that account, discount on bonds payable, that's an account. That's a T account. It's in your general ledger. It kind of gets lost the way we do this. But the numbers that are in this account, in this column, increase in carrying value, these numbers here really represent credits to the discount on bonds payable account. Now, what's the beginning balance in the bonds discount on bonds payable account? It's the difference between the amount that they were sold for and the face amount. So the difference between 500,000 and this number, 457,102, that was 42,898. Right? So if we were going to make the entry on the day the bonds were first sold, what entry would we make? We would debit cash for 457,102. We would debit discount for 42,898, and we would have credited bonds payable for 500,000. Right? And we did that in the preceding problem. But what's the balance in this discount on bonds payable account on December 31st, 2022? Well, the beginning balance on January 1st, 2021 was 42,898. 42,898. And then every time I calculated one of these numbers in this column, those represented reductions in that account. Now, I didn't use debits and credits here. All I really wanted to show you is that this 42,898 gradually gets reduced. You know, by the time the bonds get paid off, at the end of I think it was 20 years in this problem, right? At the end of the 20 years, what should the balance in the discount account be? It'll be zero, right? If I wait the full 20 years, this eventually goes away. Okay, but that's not what happened here. So what's the balance in that account?
Joining your meeting. So is this Miss Cadogan?
Yes.
This is Nassau County Family Court. Judge Mejias's courtroom. Your case with us today?
Oh, yes. I'm sorry. I'm in class.
What the heck?
So could you hold on?
Yes.
Just hold on 1 second. So the judge gets back on.
Okay, thank you.
If you've got a personal deal going on, you can mute your microphone. Okay. So anyway, so that discount on bonds payable account started out at 42,898, and every 6 months it got reduced, right? And that's where these numbers came from. So what's the balance on December 31st, 2022? It's 41,367. Now, if I pay off the bonds, right? If I pay off the bonds, then I don't have the discount anymore. So that's where that 41,367 comes from, right? And it's a credit because it goes away. You know, discount has a debit balance, so when I want to reduce it, I credit it. So this 41,367 credit will make it go away. Now, the way the textbook shows it, they show this number as to balance. I don't agree. This number is, you can calculate this number, right? 41,367 can be calculated. It's not a to balance number. This number is a to balance number, right? This is a to balance number. So now think about it for a second. You've got bonds that have a carrying value right now of 458,633, right? 458,633. That's the carrying value of the bonds, and it's costing you $601,452 to pay that off. Well, what's the difference between those two amounts? It's a debit of 142,819, and because it's a debit, we call it a loss. Loss on retirement of bonds, 142,819. If it was a credit, it would be a gain on retirement of bonds. But here, because it's a debit amount, right? You need a debit amount to balance the entry. We call it a loss. Right? So that's crazy, right? That's weird. But yeah. And again, you know, I just went over this with you. There's a video on it if you want to watch the video. I guess it says more or less the same thing I just said. But there is another video on it. So that's really bonds payable. That's really bonds payable. So let's see if we can look at stockholders' equity. Chapter 9, we move on to chapter 10. Okay. So this is stockholders' equity, part 1. I'm going to pause this again. Okay, so we're back now. Um, yeah, and that kind of says it all. Now here's the two homework problems that were done on the video. All right, so you have them there to review. And there are two videos left here, right? One is long again, 35 minutes. And the other one, I can't tell from looking at this, but I'm gonna guess that it's probably pretty close to that. So we're just about out of time today. You have any questions? Remember, the most important thing is you got to get your chapter 9 homework done before tomorrow.
Yeah, you said it's due tomorrow, right?
Yeah, it's due tomorrow, just before midnight.
Okay.
And then this you got a little time to do, because this wasn't due until what, the 25th, whatever it says on Blackboard. All right. So, are there any questions about anything? Okay. So, if that's it, then we'll just end it now, and I will send you out another invitation for Zoom for next week. And I didn't bombard you this time with, sending it out over and over again. So if there's no questions, I'll just see you next week.
Have a good weekend.
Hey, you too.
Thank you.
Thank you.
You guys have a good weekend.
Thank you, sir.